Well, greetings, my beloved clients and friends. So, today's June 23rd. We're about 6 months into a long and painful drawdown. So, I just want to give an update on where we stand and what we could possibly expect going forward. So, last week, Powell raised interest rates by 0.75%, which was the third increase in this year. First one was a quarter, second one was a half, this one's 3/4. So he's raised it at 1.5%, and it was starting from a position of zero to a quarter. So now he's over 1.5, and the other thing he said was he wants to get to about 3.4 by the end of the year. So we're only halfway through this. So there are potentially 3 or 4 more increases on deck. Okay, so and those increases are really wreaking havoc. We talked about that. The priority and the focus is on controlling inflation. And what happened was the Friday before they met and they announced the 3/4 rate hike. The inflation report for May came out, and it was bad. It was up 1% month over month, which is more than they expected, and it's still pretty high because, I mean, if you annualize that, that's 12% in a year, and that's unacceptable. So they had to act aggressively, and they did. And if they continue to raise it to 3.4, that's going to be very, very painful, because one thing you got to understand, when you're starting at a very low rate, let's say if you go from 1% up to 2%, that's a double, right? So if your cost of capital is 1%, it went up to 2%, your cost of capital doubled. Now, and if you're used to paying 1, a double is a lot, even though it's low. But if that's what you've gotten used to, then it's a lot. Compared to, let's say if interest rates were 10% and they went up by 1% to 11, that's only a 10% increase, from 10 to 11. So it's not as painful. It's much more painful on the lower end. Going from 1 to 2 or from 1 to 3 would be the equivalent is if the rates were at 8 and they took them to 24, right? 1 to 3 is a triple, 8 to 24 is a triple. So that's kind of effectively what it feels like, which, I mean, that's unheard of to take from 8 to 24, but from 1 to 3 is effectively the same thing. So that's why it's so painful. And that's what he's prepared to do to control inflation. I personally don't think he's going to have to go that high. And if everyone's expecting it and priced in that it's going to go that high, and then for some reason he doesn't have to, that would be a huge, huge relief to the markets. So keep that in mind. And so he said some interesting things when he gave his briefing, and so I want to go over one interesting thing he said. He said, for the last 40 years, we've had very little inflation, very, very low inflation. And the reason that was, he alluded to 3 things. One was the change in demographics, the aging of the population, and the slowdown in population growth. So those are 2 different things. One, the population is getting older, and as they get older, they tend to spend a little bit less. So, same size population, but an older population will tend to spend less than a younger population. And the other thing was people are having less kids. Throughout the developed world, it's kind of becoming a crisis that they're not having enough kids. So basically a declining population. So that's a long-term trend, and it's a long-term deflationary trend. Okay? The second one was technology. Technology makes things cheaper, and it makes things more efficient, so that, if you used to have to do something manually, and now you can do it with a computer, well, you're more efficient. So, you have to employ fewer people, and you get more done, and it brings costs down. All these cost efficiencies from, email versus snail mail, or, Zoom versus in-person meetings, or, any number of technological advances. And you could see it, for example, in the price of TVs, right? For the last 20 years or more, the TVs have been getting better and better and cheaper, and that's just from technology. So, and another way is, now when people go shopping, they have their phone out and they're like, well, that's too much. You need to price match this, and so, or you go buy a car and you're like, no, I know that your competitor could buy it for this. So it takes margins away from people, because the consumer is more informed. And so all those things that technology does is a downward pressure on prices. So for the last 40 years, we've been seeing this downward pressure on price, and it's been deflationary, right? So the Fed's able to, keep rates down, throw out a lot of cash, and without creating inflation. That's been the case for the last 40 years. And the third one, third deflationary point, was globalization. He said the world has been getting smaller, meaning globalization, meaning you could hire people from anywhere in the world, and you put people to work in India just as easily as you could put to work, from them driving into the office. And so that access to the cheaper labor, and just the overall globalization, the ability to get parts from any place in the world, sell them to any place in the world, get labor from any place in the world, has been a downward pressure on prices. It's been deflationary, right? Get it made in China and they could do it cheaper. And so those are just long-term trends that have been in place and appear to be able to continue. Population generally coming down, technology making things cheaper, and the globalization making things cheaper. So that was the environment that the Fed had been working in over the last 40 years. And then came a shock, COVID, the pandemic. And what happened? The economy shut down, and the reaction to COVID was massive stimulus, both from the Fed and governments and central banks from around the world. And coupled with, people not being able to go to work because of COVID and shutdowns and stuff like that. So limited supply, massive demand, and it created a ton of inflation. And then the second shock was the war, right? And the limited supply of Russian oil and Russian and Ukrainian food, and embargoes, and people and companies pulling out of Russia, and all these things. All those things created a bunch of exacerbated the inflation problem. So there's this long-term global trend of deflation, and this short-term shock that created inflation. And so when he lays it out that way, you kind of think if we could get over the hump of this shock, we could get back to long-term deflation, and the Fed being able to be accommodative. So, we gotta snap this surge of inflation. But if we can, it seems like a bright horizon to a certain degree. So, and he acknowledged that he can't fix it by himself. He could only impact demand, and the only way he could impact demand is by raising the cost of of capital. And so that only really affects durable goods, is what he said. You know, stuff that you buy on credit, because that's the only part he could control. So he goes, I need help. And he acknowledged if energy continues to go up, I'm limited in what I could do. And so he said, you know what, I need help, but if I get the help, and if you know, supply could come up, and energy prices can moderate, it seems like the economy is in a good enough shape that we could get through this. And so I talked about in the last video that, you know, Biden's made the problem worse. And in the last week, it seems like he's come to that realization that he does need to do something. And I don't have a lot of confidence that he can. Even I think Obama said, you know, leave it to Joe to mess anything up. But it seems like he's coming to the realization that if he could somehow do whatever he has in his power, and maybe even beyond his power, to keep the price of oil from going up, that could really go a long way towards controlling inflation. And so a week ago, oil was at $123 a barrel, and right now it's down to 105. So that's very encouraging. And if I'm not saying it's going to happen, but if it could happen, that, you know, oil gets back down under $100 a barrel, and it stays that way through the summer, that could be very encouraging. We could see the inflation numbers come way down, because oil is the huge driver of inflation, because it affects the price of almost any good that needs to be moved from here to there, as we mentioned in the previous video. So the problem is that the summer is peak oil usage, right? And people are traveling, they're putting more miles on their car, and in the past there was this very common play in the commodities business was, you know, before the summer you buy unleaded gas, and before the winter you buy home heating oil, and it was successful on a high percentage of the time. So hopefully he knows that, you know, he's in a period where it's going to be natural for the price of unleaded gas to go up in general, under any circumstances. And then especially in the circumstances that we're in right now, that, you know, it seems like it's the first summer where, you know, a lot of people could finally get to travel in the last 3 years, and there's a lot of pent-up demand for travel and for energy. It's going to be a hot summer, you know, so all those things are energy users. So I think that's why he's come out with this thing about this 3-month vacation, because, I mean, if you could just get to Labor Day without energy prices spiking up, you know, if you could just get through the summer months without seeing a big spike up in energy, you could go a long way towards containing inflation. So, and I know Exxon is like, well, shoot, but we're making money hand over fist, and now they're being pointed out as the bad guy. So that's a lot to ask for Exxon to take less profits. But man, if they could do it, if the energy companies could say, you know what, for the good of, right, how many times would you hear them say that, but for the good of the nation, or for the good of the economy, we're going to take less profits. And you know, the government says, you know, we're not going to collect tax on gasoline, and we're going to release more of our strategic reserves, and we're going to do whatever we can to keep the price of oil, and by extension the price of gas, down throughout the summer. We might be surprised to see inflation come under control and the market respond to that. That's a big if. I'm not saying it's going to happen, but that's what we're keeping our eyes on. And so all eyes on that June inflation number, which is coming out probably 3 weeks or so. But so that's where we are, and I'm not saying I'm betting on it. I'm saying hopeful for it. But if that happens, we could see the market respond favorably. And the other side of the coin is, if it doesn't happen, we could see the pain in the markets continue. So let's keep an eye on that, and we'll just navigate through this. Okay, we're at the helm doing our best. We haven't been right on every move we've made this year, and I'm feeling the pain right alongside you, but we'll get through this. Okay, have a great day.